Yeah, and you say QE and put a infinite on there as the possibility.
Yeah.
But so like there's two schools of thought in this, and one, debt matters, and in another, debt doesn't really matter. It's no longer the real limit. The limit might be inflation. That would be more of the modern monetary theory side of where we're at. So the one that we've been most familiar with for most of our lives, and dating for most of the time, is that balance or debt is a issue, and I would say that it is definitely always going to be in a question and will hinder growth coming out of a high debt environment. So before we even got to this point with coronavirus and a complete lockdown, we had, and not just us as in the United States, many countries around the world had a significant amount of debt, sovereign debt. So like debt that just that is just counted in terms of whatever the countries have, and then every country also had many companies within that nation that have had a lot of corporate debt. So like corporate debt has been insanely high, record high, and sovereign debt has been very high, and this will likely push it to match whatever the highest points were in the post-World War II era, when debts around the world were typically highest in the rebuilding following World War II. So we had grown a lot of debt following the 2008 financial crisis. And instead of in this last 10-year bull market, so typically when you are in an economic expansion, debt isn't a bad thing necessarily, because you are growing your economy, so you're able to slowly start to pay off your debt.
Yeah.
We didn't do that.
No.
The entire last decade we have added to our debt, sovereign debt, corporate debt, personal debt, all debt levels. So whether it be, homeowner, and when you look at the personal side, you could say from mortgage costs, or credit card, or student loans, like all of those things have grown. Every single one of them have grown in size. So
that's what the consumer market is.
yeah. And so we just got done with a decade-long bull run. We had more debt at every level. And so if you think we're going to add more debt, so that's why maybe we have effectively entered into the world of modern monetary theory, where debts don't matter and you could just throw money all around all you want, and then inflation becomes the limit. And when I say inflation becomes the limit, when you add significant amounts of liquidity into the market, that money has to go somewhere, and eventually that money shows up in price increases in something, right?
In everything that we...
Well, not in everything. Not necessarily in everything, right?
Okay.
It depends on where the money goes. So quantitative easing in the last 10 years, that money didn't show up in inflation like the consumer price index, right? Our good, we didn't have, high inflation and stuff, something that we expected to see, and a lot of people thought would happen. But you saw asset prices go up. You saw all of those things go up, even though, we had tons of debt. You saw housing prices go up, almost 50% in some places, 100% in some urban areas, which is kind of ridiculous.
I see what you mean by not everything goes up.
Inflating asset prices, right? Not everything goes up. In that case, consumer goods didn't increase nearly as much as assets did. So we saw the stock market booming. Some of that is because of production, increases in productivity, and some of it was that money that was injected in all of that time showed up in the form of corporate debt. Corporations would just gorge on cheap money that was available in the form of loans, in the form of quantitative easing, reduced low interest rates, cheap money to borrow, because that's what quantitative easing does. It encourages the lending of money, right? Going back to what you had shown earlier, and everybody that had the ability to expand took that offer. And so like that, all of our growth, the majority of our growth, not all of it, I guess, has been due to the increases of that debt. And
so in this economy, so you're saying the inflation is the only limit there is? Like when the prices of normal goods go up and people are unable to purchase them, like in the case of Venezuela or something like that, is that the limit of?
So that's kind of where modern monetary theory builds itself. So it's not like a, this is all it is. Inflation's the limit. But when you make money available and you allocate it to certain parts of the economy, if you were going to, let's say we look at the CARES Act, if you were going to make, only money available to
Airlines
consumers
or
and
something. Okay.
or we'll start at the bottom up example. So unemployment and like the stimulus check that everybody's going to get.
Yeah.
If we were like 2 trillion, all right, we're going to make a 2 trillion stimulus fund. None of it goes to corporations. None of it goes to businesses. All of it's going to go to me and you and the rest of, the regular people in the United States. That'd be awesome for us. We'd love it. We'd get this huge, like $10,000 check or something like that. I don't actually know what the numbers are. Maybe it's more or less than that. And you take that and then you go and compete with everybody else with this increase in money that you have for the goods that are still out there. So right now, nobody's going out and buying anything because nobody has any of that stimulus. So the prices of everything is falling. It's deflationary. Goods and services are going on sale in a lot of cases because those businesses don't have demand for their goods because nobody is working. Nobody's allowed to even leave to go and purchase anything. So you have falling demand for the most part. And so prices of goods and services are going down. But if everybody got money, then like maybe they would bid up the price of those goods and services. Maybe that you wouldn't see them decrease, or you would see the price increase. Right? That's just a simple aspect. That's where you would visibly see inflation, or inflation is fighting the deflationary aspect of everybody being forced to stay home and not being able to compete directly by being out at the restaurants purchasing stuff. So like that's why there's lots of deflationary forces everywhere around us, right? Technology is a deflationary force. So like technology produces and makes things more efficient and drives the cost of things down. Like I would say it's a really good thing. It's the deflationary force though. And in the minds of the brains of economists that have been kind of grown up in a world where some inflation is good and you're trying to make inflation because you think it's good, having deflationary forces like that don't make sense. And you start injecting lots of liquidity into markets and it doesn't cause rampant inflation. So you think, maybe the world has changed and inflation doesn't matter. That's not the case. It does still matter. There's just lots of deflation that exists in different places. And once you've beaten out the deflation, then there will be inflation. So like I would say when we come through a lot of the deflationary forces as a result of loss of demand, eventually, if we have such a lack of demand for so long, products stop getting made, like just because those businesses go out of business.
Yeah.
Then you see, lack of supply of those things and a growing demand for them. Then you see inflation in the price. Like inflation will exist in a lot of ways that we actually see it. We just won't see it right now.
All right. Thanks for watching, guys and gals. I'll see you in the next video, in our next conversation. If you like the video, please hit like below. And if you would like to see the next video, please hit subscribe. Thanks.